Welcome to Two White Guys with a Podcast,
We're back,
episode
number two.
So, first of all, Tony, you just presented at a dental school Midwestern, right? How did that go?
You got it. Yeah. So 2 weeks ago, we did AT Stills Dental School down here in Arizona. Today, I did Midwestern Dental School. For anybody that's watched my social media content the last 2.5, 3 years, when I first talked, I was very nervous. I was very nerdy. I kind of gave these very detailed, stat-oriented discussions. And that's how my talk at AT Stills went. My wife was the champion that she is. She came to both. She took these notes and basically said, like, dude, no one gives a crap about 89% to 88% differences. Give them facts, give them stories, let them know about what things you've gone through and people you know have gone through. And so today I just went up top, threw the same slides up. I talked about all the stories that I've heard. A lot of it are things I've lived. And I had 80 eyes locked on me the entire presentation. And my wife also mentioned I got a bunch of interaction. People were commenting back and forth during the presentation, and in none of my other presentations has there been that commentary. So long story short, it felt awesome. I feel like it was a lot of D3s, D4s. I think they felt like they got a good idea on how to get to a good job. I'm super happy, super grateful. It was an awesome experience. Anybody listening, if you're D3, D4, D2, and you would like either Alex or I to come speak at your school, give you free books, provide some lunch, that's what we do. We want to get you guys the info. So hit us up, email, DM, whatever. We'd love to come help you out.
So if they wanted to do any of that, let's just say they wanted to find you on Instagram. Where do they find you on Instagram?
Yeah, so good question. You can find our brand, The Educated Associate. You can just search that, The Educated Associate. We also have a website, theeducatedassociate.com. You can message me through there. You can schedule a video call on the website, probably DMing us. We also are at theeducatedAssociate@gmail.com. So if you're more of an email person, that's there too. Yeah, however you can get in cahoots with us, you can message on the podcast on YouTube. I'll respond to that. So many ways.
So you were trying to tell them how to find a good job. And what is the best part of our jobs? The income, right?
Yeah.
So look, we love dentistry. We want to be good people. We want to do good work. It is very rewarding. But I always tell people I'm not a saint. Look, I like money. It is part of kind of why we got into this, because it can be fulfilling both financially and emotionally, spiritually. So this episode, we are going to get into what goes into the income of a dentist. And so we'll start off with how you can be classified as an associate. So let's just say we're working. We kind of went over this in outflows, but W-2 and 1099, right? So W-2 is your traditional employee. You sign a contract. You are essentially tied to a practice, and it comes with some benefits, literal benefits. So health insurance, medical, dental, Ks, all that fun stuff. And it's got its own drawbacks. You can't deduct anything. That's usually the biggest one that people want to know. So in 1099, you are your own boss, your own employee, and you are a mercenary for a company. And I would say it's very attractive because you can start deducting things. But what I have found, the biggest issue can be the legal ramifications. So you need to be very careful if you want to be W-2 or 1099. So let's just say you join a company, you have their brand on your scrubs, you do their onboarding, you are W-2.
Yep.
So even though you might just, honestly, you should be, but the biggest difference is as W-2, you're part of their roster, but 1099, you go, hey, I come in on these days, I do the work, and that's it. I'm not tied. I don't have to do any of your compliance nonsense. So just
lean into it. Like, yeah, if you're going to do 1099, it's totally doable. There's I forget the dude's name. He's on Instagram. I think he's called like the root canal guy or something, but he's not an endodontist. He's a general dentist that primarily works out of Texas. And literally, he drives around in his car with this giant stack. He brings a microscope. He brings all his instruments. He brings from gutta percha sealer. I mean, you name it, anything he would need, minus the operatory. So you provide the chair and an assistant, and that's it. So in his case, 100%, I think the IRS would view him as the mercenary, though 1099. He's bringing his own gear. He's showing up. He's paying his own malpractice. He shows up. He does your 10 root canals that day, and you don't see him again. He's gone, and he goes to another practice the next day. And he just kind of ping-pongs all over Texas. And that's what he does. That guy is 100% functioning as a true 1099. You'll see a lot of other companies, Alex alluded to this a little bit, where I even got a job offer like this where the guy told me, he's like, so do you want me to write the contract as a W-2 or as a 1099? This is my first offer out of school. I didn't know what the heck that meant. I just knew that I was a W-2 before, so I told him, let's go that route. But yeah, that was a relatively large company, and they were trying to play funny with taxes in retrospect, probably, because I was going to be an
Yeah.
employee there 5 days a week.
Did they want you to be 10? Did they say
They wanted to be
anything?
1099. He told me multiple times in email. He was like, "Are you sure?" And he tried to explain the tax benefits, and Alex is right. There totally are. And I have a colleague that's a 1099 and formed his LLC, and he's making great money, and the tax benefits this for him have been fabulous. But as a new grad, just play it right, stay in the right lane. If you're going to work at a practice multiple days a week, work for a corporation, you're a W-2, take it on the chin, and just move on with life.
Right. So those specifics we will get to another time. But the point is, whether you're W-2 or 1099, you want to get paid. So there are different structures to how you get paid. So a straight salary, you just, hey, it's your first year, we're going to give you X, $100,000, $120,000, whatever.
You
And
go
that's
into
it.
teaching, this is how you'll get paid. Potentially, you'll
Yep.
work in the faculty clinic, and they'll pay you just a straight, basically that. Yeah.
So I'm sure there's some sort of days or hours threshold that you have to hit, but that's it. It's not a per diem. That, you should be very careful about. So straight salary is you give them X amount of days, no matter what work you do, boom, 100 grand a year. The next similar is a per diem. More likely it's a minimum guarantee. So
Common.
usually most corporations, I'm sure even private practices, when you first come on board, typically it's 90 days. So knowing that some things can go south, I negotiated mine for 6 months. So I had a
Super
down
smart.
month, but I was still getting my guarantee. In Florida, I've heard the going rate is around 700. I negotiated mine to 850. Tony, do you remember
Good for
yours
you.
or roughly know what's up in Arizona?
Yeah, I got a decent story. So shout out Dr. Soraya Safi. She goes by the Forever Associate Dentist. If you don't follow her, you probably should. Anyways, I started working, kind of chatting with her about a year and a half ago. And at this time, I had done the 90-day daily guarantee. My 90-day daily guarantee went kaput, and I didn't have it anymore. I'm working at this practice, and I get on Zoom with her, and we start chatting, and I bring up that my daily guarantee's gone, and she's like, "Wait, what? Why didn't you negotiate it longer? Why didn't you get it in perpetuity?" And I'm like, people will give it to you for longer in perpetuity. And it was just like one of those classic things. I hadn't heard it, so I didn't know, so I didn't believe it. Anyways, I went back to my employer, and I ended up doubling the rate, and I got a guarantee in perpetuity. So I'm at 1,200 daily guarantee. That's for full days when I work from 8 till 5. We don't do a lunch, so they're long days, but pretty decent guarantee. She told me the average for Arizona is like 700 to 800 for general.
How many years of experience did you have to get up to the 1,200 number?
Yeah, so 4 years, and they had seen me work for 2 years, and there was other issues within the clinic, so they knew the production numbers were there to support what I was asking for. And I really asked for this number to put pressure on the clinic for them to make sure we had adequate support with staff. We didn't have an office manager. You're not going to get things scheduled. You lose an assistant, it's hard to do dental work fast. And those were the problems that kept arising, and I knew that if they were paying me a lot of money, they would make sure that those positions were filled. So in a sense, I just used it as a backdoor to leverage them into providing all the staff that they should be anyways. So a couple years of experience, and then proof within that corporation that I could do that as long as the support staff was there. And then they went for it.
So usually after 6 months for me, whatever you negotiate, if it's not in perpetuity, they usually also have a second clause, which is a sort of percentage. So my current contract is a percentage of production, just straight production.
Yep.
So
Love
this
that.
is, the typical, it's going to be anywhere between 25 to 35% of production, roughly.
Super safe range. Yeah.
I would actually say I'm probably based off now that I think about it, adjusted production, but we'll get into that. So production, a crown costs $1,500. you are paid 30% of that based on your contract. You get $450. I do my math right? Yeah.
30%. Yeah.
Crown's $1,500. You get 30% no matter what, no matter if it's insurance, out of pocket, they collect it now, they collect it later. You do it, you get paid for it. So those numbers, right? 25, 35%. Then you've got percent of collections. These are exactly what they sound like, right? So it's only what the company, wow, you're going to snap your neck doing that.
Oh, I've been sitting in this chair so much today.
So percent of collections, right? So let's just say the Crown is same thing, $1,500, but they only collect, the fee is adjusted or something. You end up only collecting $1,000. Now you're getting paid 30% of that, which is $300.
Yep, pretty big hit.
Right. The collection percentage in your contract will be higher given all of this. The complication is when you're working in insurance heavy practices, which I am, unless you are very well versed in insurance models and payment schemes, we'll call them. I've seen the same Crown for me out of pocket, $1,600 down to like $600.
Oh, it can get bad. Yeah.
Yeah. So did
And
some
he
root
means
canals
that's
this
the
week.
insurance quoted fee. Yeah.
Right,
And I think just
And I was
real
like,
quick
oh
to
my God.
circle back, a lot of the terms like the house fee or the practice fee, a lot of companies will call that their UCR fee. So you might see that in your contracts. You might see that on their P&L statements. So the UCR fee is like the highest amount a non-insurance, a cash pay person would be charged with no discounts within the practice. And then the insurance fee is going to be different for however many insurance companies they've scheduled with, they've gone into agreement with. And it can go, Alex is absolutely right. When I was out of dental school, I had Medicaid reimbursement for $412 a crown in New Mexico. And our UCR fee was like $1,000. So yeah, the numbers and the range can be, and I even had a PPO that was like $9.98. It was like $2 less than our UCR fee. So it can go from your UCR fee to like 40% of your UCR fee, which is nuts that people agree to that.
So one way, if you want to be careful about your contract, is either A, learn about every single, and what are you drinking, Tony?
I got body armor, water, 9.5 pH.
I thought that was a beer. Anyway, so you could learn about every single insurance that exists, or just ask, if the company, whoever you're going to work for, if they just can give you some averages of what percent of their patients are in certain insurances, and you could do a quick Google search. We can help you out with that. Get a baseline of what your patient population is.
I think all dentists probably lose sleep over different things, but that was one of them for me. I just couldn't quite get around some of the low fees. Just they don't allow you to do your job. You can't do a good job at that rate. At the end of the day, it is a business, and you're not the business as the associate, so it doesn't hurt you physically or financially as the associate. But I don't know. I don't know what's going to happen to dentistry if rates keep tumbling down. Like I just got a letter from my buddy practicing in Colorado, October 1st of this year. Sorry. They're dropping the Medicaid rates are dropping universally by 44%. And you heard that right, 44%. So how are you already taking like probably a middle level reimbursement and then cutting it by 44% in 1 month? Ridiculous. Let's go back to
Not
income.
not something to talk about here. So we've got production, we've got adjusted production, and then we've got collections, right? So just something to iron out, really understand what's in your contract. Then we've got the draw model.
Live the draw for 3 years now. So a lot of people will tell you run from a draw. My takeaway from all these pay types is that really there is no universal type that's always best. It always depends on your goals, the practice, and the demographics. So when I got out of dental school, I ran away from collections contracts and I ran away from draw contracts. That might have ran me away from a lot of good deals that I didn't know. Now I've totally flipped the script. I evaluate every agreement I get offered and see what it would mean to me. I've lived the draw for 3 years. How a draw works is my draw basically functions on a quarter. So every 3 months, I have an established basal pay rate. So they pay me, I can't forget, it's like $9,200 every 2 weeks or something. And that's my draw. How it would work is if I didn't earn and I get 35% collection. So if my 35% of collections doesn't go over that 9,200, then I form what's known as a deficit. Now, in the deficit, there's multiple ways companies can deal with it. We've written stuff that talks about every 2 weeks or every quarter. Mine gets squared up quarterly. So as long as within the calendar quarter, the amount they've paid me, we've collected that, I don't owe a deficit. Now, if I do owe a deficit, they don't just suck money out of my paychecks. They would either deduce my pay the next quarter. So instead of it being 9,200, maybe they drop it to like 7,200 so that they know that my new income amount should support paying off the deficit. If you were to leave, however, in a deficit, you would owe them that money back. The scary thing being, you already paid taxes on the money that you received. Let's say you're in a $5,000 deficit. Out of that $5,000, you probably got 3,600, maybe 200 of that hit your physical bank account. So, like, how are you going to pay them the $5,000 back? Becomes the $1 million question. Just always form your draw rate as a number you know you can go over, is what I would say. Now, if you go over it in my company, then you get a bonus, and whatever amount they owe you in bonus, you just get a check as part of your end of the third month paycheck includes that amount that you bonused. And I mean, the guy I work with bonused like 60 grand one quarter. It was nuts. You know, you could set your draw so you get huge bonuses. You could set your draw high so you never get, you know, you can kind of play with it different ways. He says he'd rather never be in a deficit. He's older. He doesn't have kids at home, so he doesn't need a lot of money coming in. And he's like, I'll just get big paychecks whenever they come. I throw them in the stock market anyway, so it doesn't really matter. Where for me, I got kids, I got a family, I got routine bills, so I'd rather have my draw rate be closer to my normal amount that I'm earning. But yeah, the one scary thing is if you start noticing that you're forming that deficit, I would encourage you to actively start addressing that. In our writing, Alex talked a lot about that might allude to the office that there's not enough support staff there or there's not enough patients. I 100,000% agree with that comment. I think if they give you a normal rate and it's not getting hit, it's probably a support staff or patient issue.
Right. So that pretty much sums up, if you are an associate, the most common sorts of pay
Definitely.
models. And now we have got how practice owners make their money. So just to be
Love it.
frank, neither of us are owners. We have asked some friends, we did some research, and this is what we have found. So the first is usually owners are also employees of their own practice. So they're an S Corp or an LLC, Alex Besmer, LLC, Alex Besmer Dentistry, and the dentist, Alex Besmer, is an employee, W-2 or 1099, however you want to set it up. You are an employee of that office. So you know, it's the same idea, and we'll get into why this makes sense very shortly, but same thing. You can draw yourself up a contract to get paid off of a certain amount of your own production. So W-2, you can also give yourself the benefits, right? Because as a practice owner, you are most likely, you aren't given your health insurance, etc. You got to find it out on the free market. But you know, you could somehow provide it for yourself, get some tax benefits from that, something out of our scope. But same idea. You pay yourself 35% of collections. You would probably want to pay yourself collections so you have incentive to collect, right?
Yeah.
You can't pay yourself your own production as an owner if you're not actually collecting, right?
Yep.
Then, as an owner, you can also take the profit itself. So I have heard the average overhead in dentistry, 50, 60% maybe?
I think if you're doing good, 50, more people are 60.
Right. So let's just say you produce $1 million a year, 60% overhead, you are left with $400,000 in profit. Let's say you're going to take that home. That is a lot of money as a 1099 or whatever, as a sole proprietorship to take home. You are in the $400,000 tax bracket, right? So your marginal tax rates are gigantic.
Getting floored.
Or you take that $400,000, you are going to pay your employees, which are yourself, right? So $400,000, whatever percent of the $1 million you take is your production. And then so now your practice profit is a lower amount and your salary is a lower amount. And both of those are in two different tax brackets. And so they are taxed differently, probably overall on a lower level, right?
And the type
Same
of
idea.
income is different, which is the
Right.
key. The key difference is actually that it gets super complex, but yeah, the W-2 income is taxed as active income. and distribution income depending on when it could be short or long term. So you could really decrease your tax rate by having those distributions come out various ways.
Right. So however you want to draw it up as a draw, a salary, etc., that is up to you and your employee, which happens to be yourself, right?
Must be nice.
Yeah, must be nice. But what I have also found is that where this gets complex, similar to the W-2 1099, is in the definitions and the amount. So if you are an owner, and let's just say your production's $1 million and you pay yourself $800,000, that is an extremely high amount of your production. The government sees that and they'll raise a red flag because you are probably getting tax benefits. You are essentially not getting any 1099 or whatever, like company owner gains, and it's all an employee salary, which is probably taxed less. But the government knows what's happening, the IRS knows, and so they're going to flag them. They could probably audit you. So again, this is actually something.
And the most
to
common
talk,
way is the other way, where owners
right?
pay themselves virtually nothing. Like they might pay themselves 40 grand, and then at the end of the year, take it all as a long-term distribution and pay like no taxes on that, when they're like, no, dude, you worked as a dentist within your own practice 40 hours a week. You should have been paying yourself somewhere around a normal range. We could talk for days about what that is, but like, it's probably somewhere in the 120 to $300,000 range. Like, don't want to play accountant here, but yeah. But the way you fiddle with your W-2 status is how you can kind of feather that line as the owner slash employee of the practice.
So that is just the owner working in their own practice.
Bingo.
Then you can obviously have either multiple practices, and if you have multiple practices, you probably also have associates.
They're providers.
That you can essentially, you take a percentage of their income, right? So you can only produce $1 million yourself, but $2 million with an associate, but you only pay the associate the 25 to 35%. Everything else is yours. You don't grow four hands. So you've done twice the work and you personally are doing the same amount of dentistry, right? Very simple. Any company has employees. I remember I was listening to a podcast and this was actually extremely depressing, but anytime you are an employee, you are by definition paid less than you are worth, because an employee is a cost to a company. Wage, time, mental energy. So if you were worth $500,000 and a company paid you $500,000, it is actually in their benefit to not hire you. So that was extremely upsetting. That's why I advocate for being your own boss, but I can't practice what I preach yet. We'll get there one
Everything
day.
takes
right?
time. Everything takes time. But
This
I agree.
one was interesting that I found was management or administrative fees. But I'm just going to read this straight off our slide. So it says, in some cases, especially if a dentist owns multiple practices, they might pay themselves a management fee through a separate company. So let's say a third company. I'd never heard of this before.
Yep.
Dr. Smith owns the practice as Smith Dental LLC, the actual practice, but also owns a separate company, Smith Management Company, and they handle administration and they charge a fee to the practice. So that fee is an expense to the practice, so it reduces its taxable profit and income to the owner's management entity, which might also pay the owner. So again, oh my God, excuse me. So again, it's a little more complex, but the idea is whether you're an associate or an owner, it's not just I own the practice and I practice dentistry. There are really creative ways, and this is something that, we're starting with our own business. I always tell people it's personal finance and budgeting for dentists, right? So we could possibly go to companies, to offices, and handle their budgeting, or the dentists themselves. And so they pay a management fee, even if we do it for our own practices one day, right? We become employees of a separate company. And again, the tax and the legal implications are for another time. But you don't have to think of just, hey, I drill crowns or I own crowns, right?
Yep.
The next
Layered tax
is
strategy.
right, real estate. So let's just say you own a practice and you also own the building, right?
Golden
Yeah.
model. Yeah.
Right. So everyone loves real estate. So let's just say the owner has, a separate income stream as they are the own landlord. The practice
Mhm.
pays rent to the owner's real estate LLC. And essentially what this does is you build equity in the property and generate real estate income. So the idea is for every different business or aspect, the US has different tax and legal codes, right? So rather, it seems like it's like winning the lottery. You get a lump sum, but so much of it is taken as tax. But if you own a bunch of small different companies, you can kind of play the game and get
Mhm.
paid for real estate, for management, as the associate, and as the owner. Split these up, use different tax loopholes or strategies and tactics.
Mhm.
And essentially, the whole goal is so that when you get paid, you are lowering the amount that you are taxed on, right?
Boom. If you take nothing from this episode, that I feel like was the takeaway sentence.
Right. So let's just see. Equipment leasing. This is one that was interesting to me. It's
Section
also,
179.
well, there we go. You want to talk about that?
So this is just another great deduction for business owners. So Section 179 of the IRS tax code is a very commonly cited code. I don't know every code. But basically anything that you buy for the practice, so you buy a CBCT, that is a tax deduction to your taxable income. And this can go into like crazy things like you can buy like tractors, and not for your dental practice, but like you could own an LLC that owns tractors. You could lease those tractors to farms or companies that do whatever work with big tractors. And basically, how it works is, and my buddy's doing this right now, so that's how I know a lot of this. He made like $1 million this year, so he doesn't want to pay $500,000 in taxes. So he's buying a tractor. He's spending 100 grand for a 10. That's a 10% down payment for $1 million tractor. He'll bonus depreciate the entire tractor this year against his taxable income that will pass through to his personal taxes, and he'll end up paying zero taxes on that milli because of that. So Section 179 just basically lets you buy things for your business and deduct that from your income taxes.
Yeah. So again, you can get creative. The example that
Crazy.
we
You can
found
get
here is
crazy.
a scanner. Let's just say you just bought an intraoral scanner and you can
30
lease it to
grand.
different offices. Yep, to different providers. They can pay you a fee. I don't know
Mm-hmm.
again if like the big companies will let you do that. But,
They do.
that
But we
is
have one right now at my office, a loaner scanner from the lab across the street.
so we've got that and then kind of the holy grail, the exit. Anyone owns a practice, owns a business, probably the first thing they think about is when am I going to sell it, right? So again, you spent all this work, you worked your 40 years, you got the watch, you got the car, all that fun stuff, and you said, I'm out. You found an associate that you love, and then you're like, hey, I want to give this to you. So practice valuation is beyond the scope of this podcast, but let's just say your practice is worth $1 million and you want to give up 25% equity in it. So boom, that is $250,000 as income. Again, subject probably to capital tax that you can get. A lot of times, and this is what I was learning about Goodwill in a practice. So let's just say the tangible, the accounts, all that fun stuff, the actual amount of dentistry is worth $1 million. But the owner has spent years in the community. He is a known name. He is a face. He is a trusted figure.
Mm-hmm.
Although it's intangible, you can't put money on that. Two parties usually come to an agreement of, hey, essentially, my time was worth something. So even though the actual dentistry, like I said, is $1 million, it might sell for 1.25, 1.5, whatever, whatever you two come to, because you're also buying the goodwill of the practice, that patients trust it and they trust that the doctor that it will go to is equally as good and hopefully better than the previous doctor, right? Um, that's essentially, DSOs want to buy you, an associate wants to buy you, so it gets a little more complicated than that.
Definitely.
Usually you will see it go one of two ways. So if I would hope most likely if the owner doctor is a good doctor, he can freeze the practice value, right? So, I mean, they can establish it and there's always a practice valuation, but he doesn't want to get one over on the associates. So, not going to say they cook the books, but instead of keeping, if the associate's going to own after 5 years, let's say, they'll agree that the practice value is X and kind of no matter what happens after that, it will stay at X after 5 years. The other way, and I have heard some doctors do this, is that when they are selling to a DSO, they are looking for pure income. They probably don't care about the goodwill as much, and they know the DSO is mostly going to buy the tangible assets. So they might acquire a second office or build a second op or do something that adds tangible value, even though they may either never use it or use it sparingly, or it might just be an empty room for all I know. Right? And so what they're doing is they're trying to build the value of the practice very quickly, knowing that they are going to sell it to a DSO, right? Mm-hmm. So the buy-in, the sale really depends on, for lack of better terms, the goodwill or ill will of the owner at the time. So I'm pretty sure that just breaks down the most general ways of how you, as an associate or an owner, may make money. So to bring it back, the first is the actual dentistry, right? You do a crown, and how are you going to get paid on that crown? Do you want to give yourself a salary? No matter what you do, more or less, you show for X amount of days, given the threshold, you'll get paid a salary. Do you want a per diem in perpetuity? So no matter what happens, you come in for that day and you get X amount. So it depends on the days. There's a temporal aspect. Do you want a draw, which is usually a base, and then you take your collection or production over 3 months, 6 months, and you're essentially making a bet. Can I make more than my per diem over a specified amount of time? Mm-hmm. Right? Can I be consistent? Can I get better as a dentist? So you're essentially, I would say, like taking a loan from the practice. And at the very end,
you're totally taking a loan.
Yeah, you get paid more or less depending on what you want. Do you want to get paid a percentage? Collection, production, adjusted production. Do you get paid for the flat fee? Do you get paid for the insurance adjusted fee? Or do you get paid for all of that and what the company takes home? So if you happen to negotiate, another thing that I find very valuable, which we didn't touch on, is the percent that is collected. So from what I found is a great office will collect 97 to 98%. Someone will always fall through the cracks. 90 to 94, that's fine. Anything lower than that, I would get very hesitant. And that is something the company should tell you, or whoever, the owner should tell you. Because if they are hiding that information, we collect all the time, that is not good, right? So they're obviously hiding something.
Yes.
Another question. Yeah, go ahead.
No, keep going. I was going to say, and it's funny because I've gotten in multiple disagreements with people online that are practice owners that they either feel as though they shouldn't have to share that number while they're interviewing with you, or worse yet, I've been told by somebody who owns a lot of practices that they can't figure that out until you've worked there. And I literally don't even know how that's a logical statement. And I've told him multiple times that we're talking about math and numbers don't lie, people do. So show me the numbers. I don't know. It's a straight math equation. How much did you bill? How much did you collect? Divide the two, baby.
And it's funny because even if they haven't hired you yet, the dentist, I would hope, unless the owner takes on that responsibility, you're not the one doing the billing or the finances. You have a coordinator of some sort. So if they don't know the numbers for their own practice, red flag. If they are doing it and don't know the numbers for their own practice, double red flag.
Super red flag.
Right. The other aspect is how quickly are they collecting? Sometimes these collections will have a 45 to 60 day, because by the time it goes through insurance and you actually get the check, when are they getting that payment? Because if you're getting paid either a draw or collect, however you design it, but you're only getting paid 6 months later, you're not going to get that money till 6 months later.
If you want to take that a step further, all the people using secondary outside financing, Cherry, oh
Square,
God, no, it's the lending platforms that help people with bad
Care
credit.
Credit.
Care Credit, they take like between 5 and 25% of the fee. So that's another one that oftentimes unadjusted production gets passed down to associates. And I don't really think we need to get into a discussion if it's right or not. I mean, the practice didn't collect the money, so it's hard for them to pay money on they never got. Yeah, those things
The
like
good thing
I
about
sold
free
Invisalign
market
cases,
capitalism.
then they got on Cherry. That was the one we use, and it's like a 15% hit. And I'm like, man, there isn't as much money in these cases as I was thinking. Yeah, but I think that was a great point.
So now this is how you get a standard income. Now let's just say you own a practice. So you can pay yourself as an employee, however you see fit. You
Mm-hmm.
can take profit as just a lump sum, however you see fit. And
Mm-hmm.
then you can also rent out the space. You have equity as real estate. If you own the building, you could have all these, we'll call them side hustles, different side businesses, management, accounting, billing, if you deal with that. And you can kind of pay that company from your practice. So that profit looks lower on the tax sheet.
Yep.
And then finally, the final sale. You're done. You've done all that. And so that's essentially, I think we've covered a
Go
lot
play
of
golf.
the more traditional ways to get paid as a dentist. So if you have any questions, please reach out to us if you are currently negotiating a contract for yourself or even for an associate. Just want some tips, some advice. We would love to help you guys out. We've negotiated our own and tons of other contracts. So reach out to us on Instagram at The Educated Associate. What is the email again, Tony?
TheEducatedAssociate@gmail.com.
If you want to read more about this, I am the main writer and blogger on our
Is
Substack, also
100%.
The Educated Associate. So by the time this comes out, you guys will have heard about the outflows. We've got the book as well.
The book has a lot of the models of how associates get paid. There's a good breakdown in the first few chapters about that. It's on Amazon for sale. It's on Audible. Hit us up, DM me. I'll mail you a copy for free. I just want to get the information out to associates. So yeah, don't be shy. We want to help you guys. So like Alex said, hit us up. We're always willing to help. So good plug.
Yeah. And then if you ever want to know what will come out of your paycheck, we have episode 1, which we will link in the description here. And with that, we are out, and we'll talk to you guys soon. Thanks for listening to
Stay
Two
drilling.
White Guys with a Podcast.